Hello and welcome everyone. This is John reporting for the Bottom Line Commodity Report for the week ending September 14th. First off, let's review what happened last week. We had first FedEx came out on Thursday and announced that earnings were going to be very poor in the next quarter. As you can see, FedEx fell almost down to its predicted monthly support. Then we had Intel come out, and Intel reported on Friday that it was going to have lower expected earnings due to its poor economic growth and demand outlook. On Thursday, though, the S&Ps rallied significantly due to Mario Draghi's comment that the European Central Bank, the ECB, would help continue monetizing the Europeans' debt due from a bond buying program, a sterilized bond program, which means they're not going to create new funds or print new monies for it. They're going to take it from somewhere and put it somewhere else. But this is not a written law or a written situation because the German High Constitutional Court will vote on that on Wednesday. So, we had some international news that made people feel good that they're going to solve Europe's debt problems, but we have U.S. corporations that are saying they're doing poorly because of Europe's woes, as well as demand here in the U.S. But really, all in all, Friday's monthly unemployment report was a dismal appearance by any stretch of the imagination of any type of job growth, and so that disappointed the market. The market is really, in my opinion, pricing in a quantitative easing, but to do so 8 weeks out will be a very political, I think, to wait this long and to do it 8 weeks before the elections is making it could be construed as making a political statement or siding with the Democratic Party. I don't know. That's the talk that I'm hearing around the street. So that's why there's a 60%, the market analysts peg a 60% chance that next on Thursday, the 13th, that the Fed will come out and make a statement to some type of quantitative easing due to the poor economic growth abroad, as well as the employment jobs growth numbers here in the U.S. So what does that leave us for the markets? Well, we're short the S&Ps from literally 2 points off the highs, but we sold the December contract because this week, don't forget, on Wednesday after the market closed, we roll into the December. So I didn't know when I put out the monthly report we were going to see the market rally, this sharply this soon. I thought it would be closer, that if we had a shot of rallying, it would be, somewhere right in this week. So we're a couple days early, but that's all right. There's enough liquidity in the December. I'm not the only one that's rolling out into December. As you can see, the volume levels there. For day trading, you still stay with the September. For a position swing trade, you want to probably do the Decembers. So that was the explanation there. Moreover, when we take a look at the markets and we say, how's the structure of the overall S&Ps? We're going to take a look at the advanced decline work and the market internals in just a second. But I want you to see something here. 84 stocks in the S&P 500 are trading below their 50-day moving average. So looking at Intel, that's its 50-day moving average. It's below its 50-day moving average. So as we get into planning and scanning in this week's TTU Trading Triggers University room, we're going to cover this, but look at the amount of stocks in some of these names. CVS, CMS Energy, Cliffs Natural Resource, DeVry, Exelon Corporation, Hewlett-Packard, of course. We have, by the way, Hewlett-Packard, we had, to go on a tangent here, last week I did a lot of texting or tweeting. So if you're not signed up, sign up immediately, Personsplanet. I'm doing more alerts with tweeting than I am with the emails. I'm following up with emails, but tweet seems to get to everyone faster. Sign up to the tweets because I include stocks, I include the ETFs, and I include the futures, which brings me to my next point. I will be incorporating more stock and ETF into the Bottom Line newsletter again, mainly because of the fact, like, for example, if you take a look at the last couple months' newsletter recommendations, great calls and directions. Look at the one in gold. We were dead on in gold. I put a recommendation to buy a bull vertical spread in gold. We should have been filled. We weren't filled. It's pathetic, the type of liquidity that you get out of commodity option strategies. So forget about it. I, at the same time, went into the trading room, announced to do the GLD. If you wanted to replace doing gold futures, you could do GLD. It's an exchange-traded fund, and we did those option strategies, and we were filled there. Also, we made mention of taking advantage of the GDX, which is the Gold Miners ETF, exchange-traded fund, and we were filled there. I also went into the trading room and made mention about how we had better strength, or at least a chart pattern, from Aneco Eagle Mines versus Newmont, as well as taking a look at comparative to Barrick. So that top-down approach where we want to be in a specific sector, but yet might take advantage of the ETF, but then take a look at stocks. So from now on, I'm going to incorporate a commodity. So the bottom line newsletters, if you're auto trading this, we're still having our commodity recommendations. However, we're taking it a step further and saying, here, you do your choice. If you're not trading commodities, but you want to take advantage of that seasonal trend, here's a way of doing it. You know, I tweeted the other day about the British pound, and then we put it into a formal email alert, and we almost got filled on that. We missed it by, I don't know, 60 or 80 pips is my guess on the overnight session. What I should also have done is said, listen, if you don't like doing British pound Forex or British pound futures, here, we could do the FXB. It's the exchange traded fund. And we saw a nice move in the British pound. So from now on, I promise I'm going to do more cognizant work. I'm being aware of the fact that we can translate some of these commodities into the ETFs and stocks for you, and I think we're going to see a boost in our performance and executable trades, because we have a lot of great calls around here, but we don't get filled on some of them due to the fact that we missed the trades by poor execution, or the fact that the numbers aren't there, or the market doesn't hit us, or if it does hit us, it doesn't fill us. So that's what we're going to be looking at in the months and weeks ahead, and as we start to change this as we head into the fourth quarter, the most important trading month, or the most important trading period for the year, and especially as we're into the election year. So that's what we're looking at. As part of my tweet, I also tweeted Hewlett-Packard the other day. I had two stocks that I tweeted about. I gave you your entry based on a high close doji, and then I tweeted to get out of half the position and move your stop to break even. So you made about 20 cents, 22 cents on Hewlett-Packard trade, and you broke even on the balance. Then we had CVS. That was another one that came up. Now, we also recommended to get out of half the trade here. If you followed that directly, you got filled right at 15.11. 10 was the low, and I said get out of half your positions there at 44. So you should have been out of your fill, out of half the position, and you should still have a stop at break even on the balance of this trade as we closed here at 15.65. Not a big deal, but notice that I like this particular setup, and we're going to do more of that with stocks. When we get a high close doji and we're above the 50-day moving average, I like those types of setups. Or if we make a high close doji and we're at pivot support. So we'll be looking for more of these setups in the course of the coming months ahead. I promise you. So with that said, let's move on to our other markets of interest. The first mark of interest we have is the S&Ps, because we're in a short position there as of Friday. Now, if we take a look at the yearly low down here at 1262, which we made in June, we've rallied from 1262 straight up to the highs here at 14, as you see, 1438 and 3/4. And that's basis, of course, the September futures. All right, we're short the December, which is about 6.5, 7 handles less than. It's a discount. December has a discount premium to the spot or front month September futures. All right. Since we are in September, we're not trading futures. We're trading spots. We wanted to get in early. Remember, rollover is this Wednesday's close into December. So you can still trade September from a day trading perspective, but you can also trade December. There's enough liquidity there as well. But let's just take a look at if we see some type of retracement from yearly low, yearly high just created. 50% puts us at 1350. A 38% retracement takes us to 1370. I think we are going to see some type of correction, because on this breakout, we did not see on a week-to-week comparative analysis on the advanced decline ratio. Look, that we didn't. You can see we did not make a newer high accompanying price. In fact, volume did not accompany this rally last week as well. So this rally looks to maybe not be a full blown, I would say, broad-based rally as one would think. It did not see the participation even on a day-to-day basis on the on-balance volume, and we did not see a day-to-day basis with the advanced decline. So we'll be taking a look at this over the next couple days. As we see the Nasdaq futures, same thing. It looks like we saw that type of capitulation. We'll see if this market holds here over the next 2 days. If it sees a reversal, then of course we have many catalysts that could cause this reversal. First off, Sunday. We have Sunday night, we have China's big numbers coming out, industrial production, retail sales. Then we have coming out this whole week a slew of economic numbers for the week. So besides China, we also have Wednesday's European court decision on whether the ECB can buy bonds without permission, so to speak, or they're going to see if it's constitutional. Thursday, we have the announcement from the FOMC, which released their forecasts, and they're having a meeting, a press announcement at 12:30 Eastern Standard Time. So they'll announce whether they're lowering interest rates again, whether they're doing any type of action, and then they're going to have a press release at 2:15. So that's when the Ben Bernanke sits in front of the press as he gets grilled. In addition to that, we have several other reports coming out this week. Namely, if you come to the trading room, Butch announces this every day prior to the market starting, but we have our small business optimism, not that I think it's a big deal, but small business index comes out on Tuesday. International trade, I think it's probably more important for the three things I mentioned: China, Europe, and the U.S. FOMC announcement. On Friday, if that's not enough, we have the U.S. retail sales. So while we don't have a stellar jobs growth, we'll see if consumers were spending money as they sent their kids back to school this year. So we'll see that in the coming days ahead. So a lot packed for this next week. I'd also like to share with you the advanced decline on the Russell, because the small caps really gained strength in the last week. I mean, literally, they powered it on. And if you notice, if you are following my tweets, you know I sent very timely tweets out this week. And I think it's working out quite well. So again, I want to stress that if you're not signed up for the Twitter, do so at personsplanet.com. We tweeted that, I think, on Tuesday, because I was looking at internal market strength coming in on the Russell as well as the Nasdaq, and I said this market's too strong. It's probably going to make newer highs this week, if not test the highs by the end of this week. And we certainly did. And it was the Russell that gave me the clue to that. And I tweeted that out. You can go back on. The neat thing about Twitter is you can look at the history of these tweets. And I promise you, I'm not going to tweet on what the color of the sky is today in Chicago and tell you what's on a special dinner menu. I think everyone gets way too many tweets in that regards. I'm going to only tweet what's relevant to making money in the markets. It's because I want my subscribers to be in the know, so to speak, from what's probably pertinent from my eyes. So anyway, sign up for the tweets. I promise you we're not going to bombard you with silly things. It's information that you probably will want to know. So maybe you're not available at your email when I send an alert. I don't know. There's been a lot of different things. We're still sending email alerts out, but I think the tweets are very powerful in getting that information disseminated to so many different people that across the different needs. For those that are away from their computer but have a smartphone, and they can get that information right away. When we take a look at the Russell and we say, okay, so John, you saw that the Russell was breaking out. What does the advanced decline look now that the week is over? And as you can see here, we didn't see a stellar performance by the amount of stocks participating in this rally. We didn't see a major breakout. As you can see with the yearly highs here as well, price is pressing close to the yearly highs, but the amount of stocks, as you can see from this black line, if I've drawn it incorrectly, the high for the year, we're not seeing participation in the amount of stocks moving in conjunction with this index price action, as well as on balance volume. While we did see a pickup in the last 2 weeks of volume, it's not picking out the peak high that we saw back in July. So to me, this is a very suspect and unsustainable rally unless two things occur. volume picks up with this rally, and more stocks, the dogs like the Hewlett-Packards, the FedExes, the companies that just announced that they're not making money or they're earning less due to poor economic conditions. If those companies are picked up as a value, then I see a different story ahead. But right now, I think our valuations are overstretched. We're up over 14% on a year-to-date performance in the S&Ps, and I think a lot of this has been on jawboning and wishful thinking on the behalf that the Fed is going to come to the rescue of the markets by adding more liquidity. And I'm not sure what that's going to do other than create more buying in gold, as people are afraid of the printing presses creating inflation down the road. But be as it is, we are short the market. We have a nice stop, and we'll see how that trade performs. And I'll keep you updated as the week progresses. I hope you found this information helpful, and I wish the best to all of you this week. Thank you.